When it comes to energy costs in Europe, there's one number that stands out above the rest, a figure that can make or break household budgets and shape the strategies of entire industries. The Dutch TTF is the number everyone watches. It's the heartbeat of Europe's natural gas market, and its movements are closely tracked by traders, governments, and consumers alike. TTF, or Title Transfer Facility, is a virtual marketplace based in the Netherlands. Here, buyers and sellers trade gas contracts, and the prices set at TTF ripple out to influence the entire continent. It's the main benchmark for natural gas, shaping what people pay for heating and electricity from Britain to Italy and everywhere in between. Whether you're a business owner or a family turning up the thermostat, TTF matters. Europe's gas network is deeply interconnected, with pipelines weaving across borders. So, a price change at TTF doesn't just stay in the Netherlands, it quickly spreads, impacting costs in dozens of countries. If TTF prices rise, energy bills across Europe usually follow. Even small shifts can mean big changes for millions of households and businesses. The TTF price is sensitive to global events, politics, supply disruptions, and even the weather. A cold winter, a geopolitical crisis, or a supply chain hiccup can send prices soaring overnight. That's why energy companies and governments track it daily, using TTF data to make crucial decisions about buying, storing, and pricing gas for the months ahead. Recently, the TTF has faced major shocks, with prices soaring to record highs and forecasts shifting rapidly. These swings have made headlines and rattled markets. Goldman Sachs has just raised its 2026 price forecast, citing a cold spell that's shaking up the market and adding new uncertainty to Europe's energy outlook. Understanding TTF is key to understanding why your energy bills are changing and why the price of gas in a Dutch virtual market can affect your life, no matter where you live in Europe. A cold snap in northwest Europe means more than just chilly mornings. It sends gas demand surging. As millions turn up the heat, gas consumption spikes, putting pressure on supplies and storage. Storage sites, our energy savings accounts, are depleted much faster during these cold spells. Goldman Sachs reports January 2026, gas use is 11% higher than expected, rapidly draining reserves. This scramble for extra gas drives up prices as companies compete for limited supply. The result: higher costs and a shrinking safety net for the rest of winter. Goldman Sachs has just made headlines by raising its 2026 TTF gas price forecast from $29 to $36 per megawatt hour, a significant jump that's caught the attention of energy markets across Europe. The main reason behind this upward revision? This winter's unusually harsh cold has forced a much faster and deeper drawdown of gas storage than anyone expected, putting extra pressure on already tight supplies. By March, storage levels are now expected to be just 16% full, far below the previous estimate of 28%. This dramatic drop highlights just how quickly reserves can be depleted when demand surges. That leaves Europe with a very thin cushion heading into the warmer months, making the task of refilling storage both more challenging and more expensive for utilities and governments alike. Even by October, storage may only reach 76% full, down from earlier hopes of 84%. This shortfall could have ripple effects on energy planning and pricing for the rest of the year. The market has reacted quickly. TTF prices jumped 30% in just 1 week, reflecting growing concerns about future supply and the ability to rebuild reserves in time. Contracts for the rest of 2026 are up 16% as traders and companies scramble to lock in prices before they climb even higher. Traders are increasingly nervous, and that anxiety is pushing prices higher still, creating a feedback loop of volatility and uncertainty. Low storage now means a tougher, more expensive year ahead for everyone, from large industries to everyday households. The market's anxiety is already showing up in your bills, with higher costs for heating and electricity becoming a reality for millions of Europeans. The new forecast signals a challenging road ahead for Europe's energy security, underscoring the urgent need for both short-term solutions and long-term strategies to ensure reliable, affordable energy for all. Think of gas storage as Europe's emergency fund. When it's low, everyone gets anxious. High storage means stability and lower prices. Low storage triggers fear of shortages and price spikes. With storage expected at just 16% by March, the market is on edge. To refill, Europe must buy more gas on the global market, competing with Asia and others. This drives up prices, especially for LNG, and makes summer refilling a costly race. The pressure to replenish stocks is a key reason Goldman Sachs expects prices to stay high. Low storage doesn't just mean higher prices now. It sets the stage for a tough winter ahead. The market's nerves translate directly into what you pay. Europe's energy security depends on keeping that storage buffer healthy. There's another force behind rising gas prices: the cost of carbon emissions. Power plants must buy permits for every ton of CO2 they emit, and those permit prices are climbing. Higher carbon prices make burning coal much more expensive than gas. This keeps gas competitive, even as its own price rises. The cost of carbon is passed down the line, ending up in your energy bill. As carbon prices rise, gas becomes the cleaner fossil fuel of choice. Goldman Sachs notes that high carbon prices are helping keep gas prices firm. It's a hidden but powerful driver in today's energy market. Power companies constantly choose between gas and coal to generate electricity based on daily prices. This fuel switching depends on the cost of gas, coal, and carbon permits. When gas gets too expensive, companies switch to coal, even though it's dirtier. This switching acts as a cap on gas prices. If gas rises above coal, plus carbon costs, demand for gas drops. Recently, gas prices have hit the point where coal is becoming the cheaper option for some power plants. This shift frees up gas for heating and storage, helping balance the market. Fuel switching is a crucial safety valve, preventing runaway gas prices. The price at which switching happens is closely watched by everyone in the energy sector. It's a key signal of stress in the system. Fuel switching is the energy market's balancing act, a crucial process that helps keep electricity affordable and available, especially during times of volatility or crisis. Power plants have the ability to shift between burning natural gas and coal, depending on which fuel is more cost-effective at any given moment. This flexibility allows operators to respond quickly to changing market conditions. When gas prices soar, switching to coal can help conserve valuable gas supplies for heating homes and filling storage tanks, especially during cold winter months when demand spikes. This eases pressure on the market and helps prevent shortages. The switching point, the price at which it becomes cheaper to use coal instead of gas, depends on the ever-changing prices of gas, coal, and carbon emissions. As these prices fluctuate, so does the switching point, making it a moving target for energy traders. A high carbon price, which penalizes polluting fuels, means gas must become even more expensive before coal becomes the more attractive option. This adds another layer of complexity to the decision-making process. Right now, gas prices are sitting in the so-called hard coal switching range. This shows that the market is actively using fuel switching as a tool to manage supply and demand and to keep the system balanced. Fuel switching effectively sets a ceiling for gas prices, preventing them from spiraling out of control and protecting consumers and businesses from extreme price shocks. It's a vital mechanism for managing scarcity, ensuring the lights stay on, and keeping the entire energy system running smoothly, even in turbulent times. Understanding where gas prices sit relative to these switching points reveals just how stressed or stable the market is at any given time, offering valuable insight into market dynamics. For analysts and policymakers alike, tracking fuel switching is a key clue to understanding the health of the energy market and making informed decisions for the future. Rising TTF gas prices mean higher energy bills for everyone, households and businesses alike. For families, this can squeeze budgets and force tough choices, especially for those on fixed incomes. Businesses face higher costs too, which can lead to price hikes for goods and services. The pressure is likely to last through 2026, making government support and energy efficiency more important than ever. Uncertainty about future prices makes it hard for companies to plan or invest. This can slow economic growth and innovation. The new forecast confirms a period of sustained high costs, pushing everyone to adapt. The challenge is to manage costs now while preparing for a more stable energy future. Europe's energy crisis is part of a bigger transition to cleaner, more secure power. High gas prices are speeding up investments in efficiency and renewables. Goldman Sachs predicts tight markets for now, but a global LNG boom could lower prices by 2028. This future oversupply offers hope, but could also slow the push for green energy. Policymakers must keep building renewables and improving efficiency, regardless of short-term price drops. True energy security means less reliance on imported gas. For now, careful management and support for vulnerable groups are essential. Every household can help by being mindful of energy use. The path to a stable, affordable, and sustainable energy system is challenging, but the direction is clear.